NSE, National Stock Exchange, and BSE, Bombay Stock Exchange, are the heartbeat of India's financial markets. There are a total of 5,505 companies listed on the Bombay Stock Exchange, BSE, making it one of the largest stock exchanges in the world in terms of listed firms. There are over 2,379 companies listed on the National Stock Exchange of India, NSE, showcasing its prominence as a major hub for stock trading in the country. Okay friends, let's begin with a small story. Imagine a government school where 500 students are studying. One day, a collector visits the school for an inspection. Now, it's not practical for the collector to meet and assess all 500 students individually. So, to evaluate the school's performance, the collector selects just one student at random to ask questions. The idea is that this one student represents the entire school. If the student answers well, it indicates that the school is doing a good job of teaching all its students. On the other hand, if the student performs poorly, the collector might assume the school's teaching quality is not up to the mark. This process shows how a small part, the student, is used as a sample to judge the whole, the school. Similarly, in many situations, we use samples to evaluate or represent a larger group. Similarly, let's connect the above story to the stock market. In India, there are 5,505 companies listed on the BSE and 2,379 companies on the NSE. Determining whether the market is in an uptrend, downtrend, or moving sideways requires analyzing price movements, trends, and various market indicators over a specific period. However, just like the collector in the story cannot assess all 500 students, it is impractical to review the performance of thousands of companies individually. To make this process simpler, traders and investors rely on 1. Index performance. Major indices like the BSE, Sensex and NSE Nifty 50 act as representatives of the overall market. These indices track the performance of the top companies and provide a quick snapshot of the market's direction and sentiment. If these indices are rising, it indicates an uptrend. If they are falling, it signals a downtrend, and if they move sideways, the market is range-bound. In this way, indices simplify market analysis by serving as a benchmark for the entire market, just like the student represented the school in the story. To create a benchmark index, they select the top performing companies across various sectors. These companies are typically leaders in their industries and represent the overall market's health. For example, its sector, companies like TCS, Wipro, L&T, and HCL. Banking sector, HDFC Bank, ICICI Bank, SBI, etc. Oil and energy sector, Reliance Industries, ONGC, etc. Finance sector, Bajaj Finance, Jio Finance, etc. Pharma sector, Sun Pharma, Divi's Laboratories, Cipla, etc. By selecting these key players from each sector, the index becomes a balanced representation of the market, giving investors a reliable indicator of the overall market performance. This is why indices like Nifty 50 or Sensex are widely tracked. They consolidate the market's movement into one clear benchmark. They will pick the top 50 companies and create an index. With this index, we can understand whether the market is going up, coming down, or staying the same in market growth. This National Stock Exchange will choose the top 50 companies that are performing well as a benchmark. It's called the National Stock Exchange Index 50, and we refer to it as Nifty. In the Bombay Stock Exchange, they have created an index with the top 30 companies. It's called the Sensitive Index, and we refer to it as Sensex. For example, is the market on the rise? Is it falling? The index helps us track that. It shows us how much the market has grown or declined. Mutual fund companies rely on the index as a benchmark to drive growth. They trade based on Nifty, and many investors take part in option trading with it. On top of that, they use Nifty for hedging to protect their investments and minimize risks. It's a powerful tool that guides many in making informed market decisions. Hedging is simple. Let's say you made a profit from a stock, but for some reason, the market might drop. To avoid a loss, you buy a put option on Nifty, which allows you to profit if the market goes down. So, if Nifty falls, the profit from your put option will cover any loss from the stock. If Nifty doesn't fall and goes up instead, you'll still make a profit from your stock. The loss from the Nifty put option you bought will offset it, making both gains and losses balance each other out. In this way, you protect yourself from significant losses, and that's what we call hedging. This index is known as Nifty 50. Okay, this index is called Nifty 50. The companies in this index are not fixed forever. If any company starts underperforming or its value decreases, it will be replaced by another company that performs better. So, the list of 50 companies in Nifty can change based on their performance. There are also other indexes, like Nifty Next 50, which includes the next 50 best performing companies. These names are used to categorize and track the performance of different sets of companies in the market. It's all part of the NSE, National Stock Exchange. For example, Nifty Next 50 refers to the 50 companies that come right after Nifty 50. Similarly, Nifty 100 includes the top 100 companies, while Nifty 200 tracks the top 200 companies. There's also Nifty 1000. Apart from these, there are indexes that focus on specific sectors, like Bank Nifty, Nifty IT, Nifty Media, Nifty Health, Nifty Construction, Nifty Financial Services, and many more. These sector-specific indexes help investors track, mostly. If we go beyond Nifty, we'll be trading in Bank Nifty. But before we dive into that, on this channel, we'll mainly be discussing options trading. I'll share a lot of valuable information related to that. If you want to learn more about the stock market, subscribe to my TradeCoolMind channel. There, you'll find lots of market-related content in English, Tamil, and Hindi. You can read and learn a lot. If you have any topics you want me to cover, just comment, and I'll create a video about it in the future. Let's get back to the topic. We already covered the primary market in earlier videos, so if you haven't seen them, please check the first part. Now, let's talk about the secondary market. This is where people buy and sell shares with each other. For example, I buy from you, you sell to me, or we sell to someone else. It's all about buying and selling between people. The primary market, on the other hand, is where companies sell their shares for the first time through an IPO, initial public offering. When people buy these shares, the money goes to the company. After that, the shares are bought and sold among people in the secondary market. The second term is bullish. What does a bull do? It pushes things upward with its horns. That's why, when the market goes up, it's called bullish. In this situation, there are more buyers than sellers in the market. These buyers are referred to as bulls. Similarly, there's bearish. A bear pushes things down with its paws. Just like that, when the market goes down, it's called bearish. This trend indicates falling prices. The people who sell and expect the market to go down are called bears. If you're wondering whether it's a bull or a bear, it depends on the situation. If we buy expecting the market to go up, we are bulls. If we sell expecting the market to go down, we are bears. In simple terms, when there are more buyers than sellers, the market goes up, and it's called bullish. When there are more sellers than buyers, the market goes down, and it's called bearish. So, if the market is rising, it's bullish. If it's falling, it's bearish. The next important term is trend. If the market is going up, it's called an uptrend. If it's going down, it's a downtrend. If it's moving sideways without much movement, it's called sideways or range bound. In a sideways trend, there isn't much profit to be made. We'll discuss more about this in an upcoming video. The last concept we'll discuss is volume. Let me explain it simply. For example, at 9:30 am, one person places a sell order for 100 shares at 500 rupees each. At the same time, one buyer, A, wants 60 shares, and another buyer, B, wants 40 shares at the same price. The market matches these orders, and the deal is completed in a second. Here, the volume shown at 9:30 am is 100 because 100 shares were traded. Some people mistakenly think that since 100 shares were sold and 100 shares were bought, the volume is 200. This is incorrect. Volume only counts the total number of shares traded, so it's 100 in this case. In simple terms, volume is the total number of shares traded at a specific time. In the next video, we'll discuss more important terms used in the share market. Follow this channel for more updates. I'm your Kumaresh, and this is TradeCoolMind. Thank you.